I'm Chris Andrews. Welcome to LTF TV. If you enjoy an investment challenge, the last 6 months will have been very interesting for you. In today's investor update, we'll review the second half of financial year 2013 and consider the challenges that face advisors and investors today. In our February update, we discussed how portfolios simply had to be positioned to weather a range of market outcomes. In our view, the uncertainties facing investors made this a non-negotiable pillar of portfolio construction. And asset class outcomes over the last 6 months have borne out our caution. Taking a look first at cash, the first half of 2013 saw no joy for investors. The official cash rate decrease that had been long predicted by the markets eventually occurred in May. This had an immediate effect on the dollar, which began its dramatic decline to where it sits today, at around 91 US cents. Predictably, falling interest rates also resulted in lower term deposit rates, with the largest 5 banks now paying an average of just 3.85% on 12-month term deposits. Cash is barely covering inflation. Bonds have entered a new phase, with everyone from PIMCO to BlackRock to Vanguard sounding warnings about the vulnerability of investors in the asset class to future interest rate increases. And, just as we pointed out in February, equities have well and truly lived up to their reputation as a risk asset class, with the ASX S&P 200 down 6.5% since our February update. Now, this has wiped out all of the 2013 gains for investors, and has capped off a truly terrible 6 years for equities investors. 6 years on, the S&P 200 remains down on its 1 July 2007 level by over 25% in nominal terms, and by a whopping 36% in real terms. So, where to from here? What is the outlook for investors? Well, that depends on which papers you read. Right now, we're seeing a lot of speculation about a slowdown in China as its economy matures and leverage is reduced. Given China's status as our largest trading partner, many argue that this could mean a significant hit to the Australian economy. On the other hand, the table on screen suggests that things might not be as grim as is sometimes argued. Although Chinese growth is tipped to slow in percentage terms, that growth will be on a much larger base than in previous years. So when you do the maths, the growth of the Chinese economy in absolute terms will be slightly down on the 2011 and 2012 financial years, that's true, but it will be significantly up on the 2009 and 2010 financial years, when it allegedly saved the Australian economy from recession. It certainly does not look like a disaster scenario for the Australian economy. Similarly, currency markets are extremely bearish on the Australian dollar, with net short positions at their highest level in over a decade. With the Australian dollar traditionally seen as a growth currency, this reflects the souring view of international investors on the prospects of the Australian economy. However, a lower currency will also yield considerable benefits for many sections of the Australian economy, including our exporters. Now, these conflicting signals have led to commentators splitting down the middle as to what sort of results the forward 6 months will produce for investors. But even more bizarrely, it's not clear whether the economy makes much difference to investors anyway. A study by Philo Capital of 32 years of results has shown that, contrary to what most of us think, there is little to no statistical relationship between economic growth rates and annual stock market returns. That's why I repeat what we at Trobe Financial never tire of saying. The only predictable feature of investment markets is their unpredictability, and markets will continue to be driven, at least in the short to medium term, as much by perception and by fashion as by economic fundamentals. The fundamental challenge facing advisors and investors today is the same as it was in February. How can we generate reasonable returns without substantially increasing portfolio risk? The last 6 months, indeed the last 6 years, have been a reminder, if one were needed, that even so-called defensive equities have high inherent volatility and can expose investors to sudden and sustained loss of capital. Now, we're not talking short-term fluctuations in values here, but capital losses that persist for years and years, certainly much longer than many investors can bear. Cash will help when it comes to capital protection, but is unlikely to provide much in the way of real returns for at least the medium term. For those advisors and investors practicing tactical asset allocation, this sort of environment is leading many to neutral weightings of portfolios. If anything, we're seeing risk-averse investors in particular going underweight on equities and riskier assets until the dust settles a little further. Now that, of course, does not exclude the prospect of there being real value in markets, and that may be a focus for some contrarian advisors and investors. The most important considerations for these advisors and investors are, first, that portfolio risk exposures are properly recognised and measured, and second, that portfolios retain a base of low volatility assets to provide protection in the event of continued market uncertainty. It's been another terrific 6 months for Trobe Financial, with a continued focus on the asset origination side of the business paying handsome dividends. At a group level, we've settled yet another large institutional mandate of $400 million for a 3-year investment term in a separately managed account. Now, this is yet another testimony to our ability to perform for a variety of investors across the economic cycle. We are also really pleased to report that we've originated well over $1 billion worth of assets in financial year 2012-2013. Our fund, our retail offering, has continued to see strong inflows from advisors and investors across Australia and now holds well over $530 million in funds under management. Our contributory schemes, the direct and high yield mortgages options, are generating a diverse range of attractive investment opportunities. And our flagship pooled mortgages option is growing strongly month on month as it maintains its margins over cash and term deposits and retains its outstanding ratings history. Most fundamentally, we remain absolutely committed to the Trobe Financial philosophy. At all points of the cycle, we are aiming to be that reliable, conservative, income-producing investment that anchors portfolios. Fads and trends come and go, but for us, investment remains a simple matter. Getting rich slowly never goes out of fashion.